Stephanie, let's start here because when you look at financial conditions, I don't know, I guess it depends on what side of the fence you're on right now. You can look at things and say financial conditions are certainly easy, the money's there. There are some people, though, they see tight conditions now and even tighter conditions up ahead.
Yeah, so the way that, we see it at this point, we do believe that we're in for a soft landing, right? So we do think that you do need to be prudent in terms of putting risk on. But I think finally, after, about a year of preparing for the Fed to cut interest rates, we're finally at a point where we feel confidently that the Fed will cut rates. And it might be time to start to look out on the curve, and maybe duration risk is where you want to go as opposed to credit risk at this point.
Do you wait to do that, Stephanie, until either we get that first cut or at least a little bit more of a definitive statement that that first cut is coming, or do you try to position around it now?
We really think you try to position around it. We think that you start to leg into that trade. Typically, when we look at, right now there's still $6 trillion in money market funds. Typically, the individual investor stays in money funds and stays in cash much too long. So you want to start to leg out on that trade. You want to start looking at the ultra short funds in the space, because that 5+% on the money markets is not going to last.
Yeah, people keep telling me that, Stephanie, and I keep not listening. But, it's a fair point. I want to get to the long end part of the equation, because it does feel like higher yields may actually be here for longer on the back end, even if the front end winds up coming down, particularly if we get a President Trump in the White House and we get something like weaker growth and higher inflation.
Yeah, we certainly, have a thought process that is in line with what we're thinking here. We do think that we're likely to see some steepening on the curve, which, again, we've been waiting for quite some time. So it'll pay off to be longer on the curve at some point. And we do agree that with, the political backdrop that we have now, we're likely to see the longer end kind of stay anchored to where it is while the front end comes down.
Okay, so you see the 10-year not coming down, just not going up either.
Well, we see it coming down marginally. I would say we're looking, when I say, kind of staying anchored, we're looking further out in the curve. So we look at the 30-year, we're likely to see that kind of stick around where it is right now, with the 10-year coming down marginally.
So, Stephanie, as we sort of push ahead, I do have to ask you a little bit about election risk, particularly for those folks who are counting on rate cuts and rate cuts this year that would require even greater repositioning, greater rotation than what we've already seen, not just in fixed income, but across all the major asset classes. Are you worried at all about that maybe running into, I guess, complications, if you will, from how the election shakes out in November?
That's a great question. Right now, I think, what we do know is that President Trump is the nominee for the Republican, ticket, and that was no surprise. I think the market is really pricing in a lot of what we're expecting from a political backdrop. So, right now it's just my crystal ball is a little unclear when it comes to the political side of things. There's just so much that can happen between now and November.